Welcome to the March 29th edition of Market Thoughts. I'm Dave with Lighthouse, and just ahead, we're going to recap a week full of news on the war front, inflation, fertilizer prices, biofuels, China, all of that packed in. What's it all mean? We're also going to preview the biggest report day of the year coming up on Tuesday, quarterly stocks and planting intentions, our analysis, our thoughts, including the impact of this chart that's in front of you right now. But before we get into that, commercial as always. Market Thoughts is remote. We're actually on site out of state visiting a college. How did we end up here this week? I told my daughter there's two choices for her to go to college. One would be to go to North Dakota State. Two would be to go to any other university on earth other than the University of North Dakota. And she went with option two. But being remote and being on site has got me thinking about over the last 10 and a half years, almost 600 editions of Market Thoughts, all the different places we've come at you from time to time. And that also is a good segue into what's next on our analytics here. We've got the quantitative analytics that are in front of you. You got the voice you're hearing now and the actual traditional analytics that we're doing every week. And we've been fitting those together. We as humans have been fitting those together and drawing conclusions. We're in the early stages of a very expansive effort that's going to take 10 plus years of all this analytics data of ours, all this quantitative data that's in front of you, all of our phone calls, emails, discussions, everything that we thought about at a given time in market, and train a model around that to be able to actually assess in real time, in a manner of speaking, what our own thoughts would be given the situation that's in front of us on any given day. That's going to be the next big level up that's coming out of a decade of innovation on analytics at Lighthouse. But on the cusp of that, just recapping what you're looking at in your daily emails now, your text, if you log into the website, basically price signal that we've had forever. The higher that signal gauge climbs, the stronger it is of a sell, the lower, the stronger of a buy. Market gauges from short-term to long-term staging up. The higher the number it is, the higher that specific market gauge says it is to sell. And then our big innovation this year, our big leap forward from a learning standpoint with this data is taking the below and saying what happened on days that were most similar to a day like today, a day with this price signal, these market gauges, what happened next? In the case of corn, 39% of the time when we had this setup, price was lower over the next 20 days. So even though this analytics are quite high, this exact setup, price actually tended to still trade higher in the short term. This is the change over the next 20 days, the expected change of plus 3.8 cents. So historically, when we had this setup, this is what the expected change would be. That gives you some much needed context along the way. So that's what you're looking at when you look at a chart. If you see, for example, a sell signal, high market gauges, negative expected change, that's saying, hey, this is a really strong time to sell based on these analytics. So just commercializing that again so you know what you're looking at every single day. All right, let's talk some fundamentals. Let's recap. If I can grab the right charts here, there's a bunch of charts. Don't let that scare you. We're going to move fast. So basically, just on the geopolitical front, a couple things to just note. Despite all the rhetoric on all different fronts, the situation is still pretty taut. There's definitely still active fighting in the Iran, Israel, U.S. conflict. Something else that probably didn't get enough headlines is if you look at how this is unspooled and how desperately the world, if you will, is trying to free up energy prices. You've seen where Russian sanctions have been lifted and eased to try to bring some of their oil back into places that are affected by not being able to get oil out of this region. And Ukraine responded by attacking deep into Russian territory and taking a bunch of their oil production offline. So you still have a pretty, in a way, that conflict's expanded. I would say we, just Lighthouse, our conclusions were more worried about higher energy prices this week than we were a week prior. Now, we'll get to what that means for grains here, but at the same time, we had said, hey, I think we've priced in this initial round of this. Soybeans had really stopped reacting to energy prices and whatnot. But if there's another big run up, this is something worth noting. So this would be a neutral to bullish bias as far as how energy prices impact grain, where the previous 3 weeks it was neutral to bearish. You had a couple other things that played out. You had, of course, the U.S. and China announcing a mid-May date for President Trump to travel over there and to discuss trade. And then the other thing you had is this celebration of ag. And I'm not going to get too into the weeds here on this, but just the takeaway, the EPA finally announced blending targets for renewable fuels for 2026. And suffice it to say, big increases, especially for renewable diesel. But these are the leaked numbers. These are the numbers that everyone knew about going into it. So that's what happened during the last week. And what did that do to prices then? Let's look at how this affected your daily charts then, and then we'll talk about why. So corn actually lost 3.5 cents on the week to close at 462. If we look at our daily chart, here's how this played out. You still have a really well-defined uptrend, but you're bringing this to a choke point. Now you have a near perfect, if I draw a line from here and a line from here, a near perfect triangle that's set up for a breakout. And we'll talk about which direction we think that breakout is. But this is where you're at with corn. It's been 3 weeks now since your high. You've maintained this uptrend, but you haven't been able to break through it. This is a pretty precarious spot you're at on this chart. And if we look at soybeans on the week, lost 2 cents, pretty tame and maybe a bit of head scratcher. So this is how it played out. This right here was, hey, this China meeting might not happen at all. Beans limit down, trading more than limit down synthetically. This was, we're waiting on more news from China. This ended up 16 cents higher, was, hey, there's a date on the calendar. And so that got us Wednesday into Thursday. What about this, though? These big losses on Friday. This is classic textbook, buy the rumor, sell the fact. You were and we talked about this in the run-up on the biodiesel. These are bullish numbers. That's part of why this rally that goes back this far and whatnot. But at the same time, they were the numbers the trade expected. Giving the market something they already know is not bullish, and oftentimes just the certainty of it. Okay, there is no chance this is going to be bigger than we thought. This is what it is. You can see that lets some of the air out of the balloon. So here's spring wheat. Spring wheat actually fared the best on the week, gained 20.25 cents, new high weekly close. This chart's been erratic. We liked wheat here just chart wise for a breakout lower, is kind of listing and tipping over, and that's obviously wrong. It closed out with 4 consecutive higher highs. This is actually weather driven. Wheat's still sensitive to energy too, but weather's also a driver. It's getting way too dry in the high plains. The trade's starting to pay attention. So more on wheat in a second, but when you pair this with what we think on acres on spring wheat, that's actually not too bad a spot that wheat's in. So if we look at a rare moment in time where wheat actually looks better than corn and beans for the moment. Okay, let's all take a breath here. That's what happened last week. That's what it did with price. Here's where we sit. So let's talk about 2 things we have coming up first here. First is you've got quarterly stocks. This doesn't get the magnitude, if you will, to use that word. It doesn't get the magnitude of exposure that acres do, but it's arguably as big, if not bigger. And corn coming into this, there's something we need. These estimates probably don't mean a lot to you, not to near the extent that acres do. But suffice it to say, corn potentially has a pretty volatile stocks report. And here's why. We haven't talked about this in a while, but let me break down this chart for you just quick. These numbers, don't let this line fool you. They're almost identical, from 99.64 to 101.88. That's animal consuming units. And you go back to 2019, virtually identical, no change, still below the 2019 and 2020 levels. The red bar is corn, feed, and residual on the balance sheet. So last year with 99.95 animal consuming units, you had 5.5 billion. This year, you're at 6.2 billion expected feed usage. This doesn't pass the smell test. Like this doesn't make any sense. So you have one of 2 things. Either carry-in numbers were wrong on corn, and this is how you're fixing it on your balance sheet, which it could be. And we don't have a hot take of which one this is, but either the carry-in was wrong or you were using this feed and residual number to prop up your overall carryout on corn, to keep it from getting out of hand, to keep it from getting too big, and ideas that you'd come down later. And this is all fine, but it starts to come to a head in this March stocks. You're halfway through the year. There's potential here that you get a bearish stocks number. If you don't, I think you can say without reservation that those carryover, those prior year corn production numbers were overstated, and this is how you're fixing it. But this stocks number is high stakes, and there's very little potential that your stocks number is bullish. There's elevated potential that it's bearish. Parallel to that, it's also just worth noting, everyone, that corn exports have started to fall just a touch behind. This was the belle of the ball the whole year, and with this price run up, you're starting to run behind the pace needed. And just also worth noting, soybeans, if I can find the chart, I can't, but I don't need a chart to explain it. Soybeans is actually still well behind the pace needed. So you've got some internal demand things that you haven't thought about, and we lean just a little bit bearish on this stocks report. And then you go into acres. If we look at acres, trade's looking for 94.37 million corn, 85.5 million soybeans coming into this report, spring wheat 9.84 million. And what do we think of those numbers? And there's been this thought, of course, not an unreasonable one, that with the run up in urea, that corn acres are going to fall. They're going to be down even more than this 4.5 million acre drop from last year. I think it's important to note that these surveys were done before the full effect of that urea came in to the equation. They were filled out in late February, early March. And then also, at least among our client base, and I don't know how representative they are of the behaviors of corn growers overall, there's been nobody changing any meaningful acres based on this. Everybody's saying, well, I think my neighbors are gonna, but they're saying, but I'm not. Either I already own fertilizer, I own most of it, I own enough that I'm not changing. So I think when we look at this urea story, I think that is a big deal for the Southern Hemisphere crops the second half of this year, and potentially a huge deal for the following year. But I don't think it's going to change these acres decisions. Also worth noting, years with similar low cotton. So corn and beans are nothing to write home about. Cotton and rice prices are terrible. Those margins are really, really bad relative to, so you can throw 22 out of this scenario because that was ultra high commodity prices, but you have had 3 other years where starting the year out, you had relatively low prices. 2012 obviously ended up being a huge rally, but you started with relatively low prices, and you had similar low cotton to corn and bean price ratios. And in each of those years, you had over 2 million acres switch out of cotton into corn and beans. So then if you take this and look at similar 2023, for example, your principal corn, bean, wheat acres were 227 million those years. You're only forecasting 224 million this year when you look at the estimates that we looked at, are 224.71. And then here gets to our slide we started this whole shooting match with. Lighthouse is big enough now. We have statistically significant representation of U.S. corn and bean production, and we've actually able to not, it's not even a survey really, it's you guys as clients telling us these are my acres, because that's how we market your grain. That's how we know how to work together. So this is where we're at. Corn acres down 2.6%, soybeans up 4.8%, wheat down 31%, and canola up 82, just under 82%. So interesting nonetheless. And if you fit these all together, this corn down 2.6, beans up 4.8, that fits our analysis. We're calling for 96 million corn acres, and you'd be right about 85 to 85.5 million bean acres. Again, not predictions, not something to base any huge decision on, but that's what our analysis is telling us when we look at years with this corn soy ratio, when we look at years with this ratio of corn and soy to rice and cotton, when we look at our surveys of our lighthouse clients, et cetera, this 94 million looks too low, and this 85.5 looks right on. Embedded in this also, spring wheat definitely a bias for lower acres. They're not going to be down 31% overall. If that would be wild, unprecedented, but definitely trade looking for acres down roughly less than 1%. It's going to be more than that. You're going to be below the low end of trade estimates on spring wheat acres. So that, and then just if you are a canola grower as a listener to this, one thing just to balance that, oh my gosh, canola acres are up double in North Dakota. Still very small percentage of the North American canola is grown in North Dakota. There's some implications for basis and whatnot. It may, but it's not a gigantic driver of price. So, but again, that's where our take would be. We'd be just above 96 million on corn. We like the 85.5 for beans. Wheat should be below the low end of trade estimates. All that informed by all the analysis we just did. And our actual planting intentions survey, if you will, of our statistically significant sample of all of you guys, Lighthouse clients. Okay, so that's what we're thinking coming ahead. We've got stocks and acres that are set up to be, I think you got two conclusions here. One, it's unlikely that you're going to get real bullish data on either front. I think it's actually tough to get a combined stocks and acres number on Tuesday that would be very bullish or even slightly bullish. And I think you have a pretty clear path to where this turns bearish. And when you fit it with everything else, the biofuels announcement being a little bit of a dud, nothing else coming out of Celebration of Ag. The market at this stage is priced in war premium. Export demand is starting to level off. You've got a lot of just fundamental signs. If you look at spreads and basis, you've got a lot of fundamental signs that grains have run high enough for the time being. Your two counterpoints to that from fundamental non-quantitative analysis are essentially seasonally, grains have a strong tendency to rally. You have a whole season of weather ahead. It's very unusual to make. In fact, you've never made calendar year highs in March. That would be a first if that's true this year. And then from a overall standpoint, this kind of 2008 to 2026 scenario, 2008, you had very similar fundamental case and you continued to rally all the way through based on runaway energy prices, skyrocketing inflation, some of the same things that are starting to unfurl right now. You had huge increase in biofuels demand that year. You don't have the exact same setup, but it's difficult not to compare the similarities at this point. So that would be the counterpoint to that, and that's where our analytics come into place. So we hit on corn already. This is a corn analytics setup that, especially on the highs, you had a sell signal, you had all of your market gauges except seasonal relatively high, extremely high. Right now you have a slightly supportive classifier, but you had a bearish classifier on your highs. I think corn is definitely one where how we would synthesize these analytics and say, let's at least get hedged what we wanted to get hedged ahead of the growing season. No reason not to do that. In most cases, we've done that already. There's a little, let's wait on that inflation story to play out, seasonal story to play out. But if there was grain I was wanting to get hedged this winter, it should have happened already if it hasn't, just based on everything we talked about fundamentally in this analytics view. So if you look at soybeans present a more neutral analytics case to now. Earlier, of course, you had a strong sell signal, but you've got very bullish seasonal. You've got a neutral classifier, slightly bearish, but we would call this neutral. Your signal's in the bottom half of its range. Soybeans are back to more of a neutral view, and that fits with price being in the middle of its recent range going into the report. And then lastly, just on wheat, if I can find wheat without guess too many times. So this is your setup on spring wheat. There wasn't enough classifier data points on Friday to actually list as that's something too. You can get days where there simply aren't enough similar days to draw a meaningful conclusion, and it can be very misleading if you do that. But we'll get a fresh look on classifiers as soon as we have enough days again. This analytics data certainly supports hedging. A signal up in the 60s, Beck's at 100, momentum's at 100. You have a bullish seasonal ahead. Your price to stocks to use is more neutral, But so this is an analytics look that supports hedging, but certainly our take on spring wheat acres are going to be way below expectations. It looks like a wet spring in North Dakota that could further challenge getting those acres in. And you have the expanding drought for the hard red winter wheat. This is something where I would not be looking to push aggressively on more wheat hedging at this time. So those are the takeaways going into the report. We'll see what Tuesday brings, see what happens on the other fronts. And as always, we'll update our analysis and talk about what to do next from there when we gather up again in early April.